Hello and welcome to another Smooth Economics video. In this video we will be looking at total revenue, and this video forms part of our wider revenue topic. So total revenue, to recap, is defined as the total income a firm generates from selling its output. The equation for total revenue is total revenue TR equals P times Q, price times quantity. We're now going to try and graph total revenue, starting with the total revenue curve for price setters. These are firms with a downward sloping demand curve. Their total revenue looks a bit like this. So we start low at the bottom, going up to a peak in the middle, and then coming back down as our quantity increases. We can see this is the case by considering a demand curve as well as our total revenue equation, TR equals price times quantity. TR equals price times quantity is represented by the rectangular area between a point in the demand curve and the price and quantity axes. So here, when price is high, although the average revenue is very large, quite high up here, the quantity is very low down here. And so the total revenue we generate is relatively low. But if we cut the price a little bit, the revenue increases by a lot. So we've gone from this area, this total revenue here, to this one here on our total revenue curve. There's a small proportional fall in price as we cut the price, but the quantity we sold has increased by almost 100% in this case. Cuts to price continue to increase total revenue up to the midpoint of the demand curve. This is because the proportional rise in quantity outweighs the fall in average revenue, the fall in price. The TR curve is flat at this point, so the gradient of our TR curve at the top is flat. The gradient equals 0. After the midpoint though on our demand curve, the cuts to price are detrimental to revenue. Whilst the firm is still selling more revenue, Q has continued to increase. The proportional fall in price outweighs the gain in output, and the firm would have actually generated more revenue to have a higher price and sell a slightly lower quantity. For price takers then, firms with a flat demand curve, total revenue looks a little bit different. It looks like this. It is upward sloping, a straight line with a constant gradient. This is because on the perfectly elastic demand curve that for individual firms that are price takers face, the firm doesn't lower its price as quantity increases, so there is constant marginal revenue. Total revenue increases at the same rate regardless of the quantity sold. So initially, the price is still here, the quantity is low, TR is given by going up here on the TR curve. As we increase, our TR increases steadily. The area of our price times quantity rectangle again increases at a constant rate as we increase our quantity. Thanks for watching this Smooth Economics video. Don't forget to subscribe to our channel. You can also visit our website www.smootheconomics.co.uk. Here you can find more resources, extension materials, details of upcoming courses, competitions and much more. We are also on social media. Follow us on Instagram, Twitter and Facebook with the handle @SmoothEconomics. Thanks again for watching, and we hope that you continue to enjoy our videos into the future.